Hey, this is Tom. Don't click nothing, don't smash nothing, don't buy nothing. Let's talk about what's going on with Deutsche Bank. Down as low as 8% on a day, bounced back a little bit towards the end of the day. As of the making of this video, it's down 3%. So, what's going on with Deutsche Bank? And should we all be worried? So, let's start with the obvious question, why Deutsche Bank is dropping right now. Well, the simple answer, and it is quite simple, unlike what these talking heads with their expensive suits and their expensive studios and mainstream media are trying to push on you. The answer is quite simple. Look, when people are making money, nobody's looking under the hood of these banks. When people are not making money and times are tough, people are flying from risk to safety. And a lot of these problematic banks are getting punished. They're getting priced in the risk that they're carrying. Now, Deutsche Bank has been known to be one of the more problematic banks in this global important system. Not as bad as Credit Suisse, but it has its problems. It has exposure to the German economy, which isn't great, exposure to Russia, as well as a host of other issues. But the crux of it isn't the problems of Deutsche Bank, because every single bank has problems and exposures. The problem is now, after the collapse of Credit Suisse, in the aftermath of that, people are looking under the microscope, looking for the next Credit Suisse. And obviously, they're going to look at the weakest link in the global important system of big banks. And the natural candidate is Deutsche Bank because of their problems. Now, is Deutsche Bank going to fail? Probably not. Will Deutsche Bank be bailed out by the German government if that happens? 100%. It's just too important. But at the end of the day, I'm here to explain to you this isn't a Deutsche Bank problem. No. This is a global banking crisis, and it is a lot worse than what they're selling to you. Deutsche Bank is down, that's fine and dandy. But do you think Wells Fargo, you think Bank of America are doing any better? No. Look at their share price for the past month. You're going to be shocked. Wells Fargo down 22%. Bank of America down 20%. Now, they're suffering from the same fate as Deutsche Bank, but people are talking more about Deutsche Bank today. But Wells Fargo, Bank of America are getting beat up just as much. And the reasons are quite fascinating. And this banking crisis, might I add, is much further from being over than what they're leading you to think. And in this video, I'm going to show you exactly why this is happening, how bad the situation is, and what comes next. Now, first of all, you have to understand that the entire banking system has been bleeding money. And it's been doing so for a while under your nose because the media was not talking about it. Now, if you're a customer of a bank and you're getting, let's say, 0.5% for your deposit, you can put your money right now in a US Treasury and get 4 to 5% on a 3-6 month Treasury. Literally almost risk-free, get 4 to 5%. What do you do? Well, I think the answer is quite obvious, and it's obvious to a lot of clients. That's why a lot of the high net worth clients of the banks are taking money out and putting it in money market accounts. Why get 0.5% when you can get 4 to 5 with very similar risk profiles? In fact, some would argue that treasuries are way less risky right now than the banks, and they're giving you higher interest. It's a no-brainer. So that's problem number one for the banks. Now, this has been going on for a while and drove a lot of the issues of these banks. Now, the issue has gotten a lot worse since the Fed decided to absolutely fuck the banks. Now, I know the words are a little bit harsh, but this is exactly what happened. Look, the Federal Reserve let these banks, in fact, encourage these banks to buy bonds because bonds is the safest place to hold customers' money. The problem is that the price of these bonds is determined predominantly by the interest the Fed sets. As long as the interest is very low, the price of these bonds is extremely high. So these banks were buying bonds at a very high price, exactly what happened to SVB. Now, at some point, the Federal Reserve went from, well, it's not transitory. Let's raise interest at the highest pace since Paul Volcker. Let's go crazy, 5% in a single year. The moment the Fed decided to do that, all of these banks got slammed with their penis in the mousetrap. Pretty much, they couldn't do jack shit. Their interest rates drove the price of their bonds down so low that they have a massive, massive exposure. Right now in the US, US banks are sitting on $1.7 trillion of unrealized losses from bonds because of this exact situation. This wasn't a Silicon Valley Bank limited situation. This is an issue for every single US bank. $1.7 trillion. In total, we have about $20 trillion of deposits in the US. So this gives you kind of the figure of how bad things are. Now, once the Fed raised rates, the banks that had zero risk profile and the worst management and were an absolute freak show of management, they collapsed. Signature Bank and SVB, they got knocked out first because how gruesome the management was. Zero risk profile, no interest swaps, so they got wiped out. Now, the other banks are still alive, but they're shaking. They're pretty much holding on to their balls, trying to figure out how they're going to get out of this. Now, it doesn't help when the Federal Reserve basically sends out Jerome Powell yesterday to talk about what's going on. And for the better part of his speech, he does very well. He talks about bank security. He talks about how important it is to keep bank stability. He starts his whole speech with talking about banks. But then in the Q&A section, the gentleman from Bloomberg TV asks him, well, Jerome Powell, do you think that you guys will drop rates sometime this year? And instead of dodging the question, instead of saying, well, we don't know, we'll see, he literally said no. The minute he said no, this means that this problem for the banks is not going away in 2023. This means that the whole confidence in the banking system goes back to the floor because now everybody with half a brain that are basically analyzing these banks now know that they're sitting on a huge pile of unrealized losses. And now the Fed just said, well, we're not lowering rates. So your problem, your mismatch problem is going to continue all through 2023. Congratulations, Jerome Powell. You just played the entire banking system. Now, again, I don't know if he's actually going to walk the walk, having talked the talk, but the damage to the confidence of the bank was done. And that's why the next day you're seeing all the banks bleed because of what Jerome Powell said. The Federal Reserve basically took a situation where every bank is under a microscope right now. And it made it a lot worse by saying categorically there's not going to be any help from the fiscal policy. And don't forget, every central bank in the world is looking at the Federal Reserve. They're going to copy what the Fed is doing and they're going to implement the same policy in their country because this is how the monetary system works. All the central banks are heavily influenced by the position and the strategy of the Federal Reserve. And if you thought that's bad, hold on, we actually have more. That was just half of the problem of the interest rate spikes. The other half is all these banks, they make money on giving out loans, on lending money. Now, the banks were giving a lot of loans when interest rates were low. So they were giving 3% loans and they locked it up for 3, 4, 5, 6 years, whatever. Not even talking about the mortgages, God forbid, that are basically locked up at 3%. Now, the cost of capital right now for banks is very high. So their net interest margin, that spread is gone. And every interest rate hike that goes up is basically eroding that even more. So when Jerome Powell comes out yesterday and says, well, here's another 25 basis points hike, poof, it's another uppercut to their chin. It's not a good situation. So given everything I just told you, given what we just heard from the Federal Reserve, I think that the banking crisis is far, far from over. Now, what happens next is dependent almost entirely on the policy of the Fed. You see, the banks run on confidence. As long as people have confidence in the bank, they'll be fine. If they're not, no bank can withstand a bank run. And no bank will withstand a bank run if people lose trust in the banking system. Now look, the direct cause of all of this crisis right now, this specific crisis, is caused by elevated interest rates. You cannot go from 0 to 5% in a year and not expect the banking system to have major pain. If you go from 5% to 10%, it's a whole different situation. But you literally went from almost 0, not really 0, but from almost 0 to 5% in a single year. You basically screwed all these banks. Now, the question is, now that we've seen things break, the Fed has to decide what's more important. That 2% goal, whether they can achieve it or not, or the stability of the banking system. Now, in my personal opinion, again, might be inaccurate, might be wrong, might be the ramblings of a madman. In my personal opinion, I don't see how the Fed can keep being hawkish and attacking inflation while the banking system is on the verge of collapse because of elevated interest rates. The Federal Reserve is a paramedic. The paramedic is on the scene of an accident. A person is on the ground. He's bleeding from his head and he has a broken leg. If the paramedic decides to treat the broken leg, yes, the leg will be fixed, fixated, whatever. But the person is going to bleed from his head and die. So fixing inflation is like fixing a broken leg when the entirety of the banking system is wobbling and shaking. You have to prioritize which things you address first. And the question is very simple. Will the Fed follow through on this strategy? If the Fed stays true to what they're saying, if they will walk the walk, the banking system will be in trouble. And because we're coming off of an inflationary cycle with massive amounts of cash dropped on the market, the Federal Reserve does not have the usual time to wait and see what's going on. In a usual normal market, the Fed would wait and see how bad this gets for the banking system before actually acting. But because we don't have that weapon of massive quantitative easing, we can't just throw money again at the market because we just came off of a huge inflationary cycle fueled by money piling on the market. So the Fed cannot allow something serious to break. Because if we actually go to an absolute collapse of big banks, the Fed's only solution will be to go heavy QE. At that point, it's going to be too late. That weapon is already exhausted. So they can fix it right now when the problem isn't as big as it could be, when it's just a cavity, and not wait for the tooth to rot completely. It's a little bit unsettling to me to know that the last time they had that opportunity, they screwed it up. They could have stopped inflation when it was small and slow by raising interest rates, but they chose to basically wait and see until the whole thing went absolutely kaboom. And then they stepped in, and then the late response caused more problems. My hope and my belief is they've learned from their mistakes, and this time they will not let the banking system go too deep under, so they can solve it with a few interest rate reductions and a slowdown in the quantitative tightening. Again, I don't have a crystal ball, but that's how I see things. If you agree, if you disagree, let me know below. And as always, don't forget to check out my platform, Stock MVP. The link is going to be below. You get to try it out for a week for free. If you actually want to get it for a whole year, the code is LAST50 for 50% off for a lifetime of use. Look, in my own humble opinion, this is one of the best platforms to research stocks. I built this research tool from the ground because I couldn't find anything like this on the market, something that will allow me to look at financials, model DCFs, look at insider, look at institutionals, look at trends, look at actual SEC filings, all at the same place. I absolutely love this platform, and I think if you try it out for a week for free, you're going to fall in love with it as well. Regardless, thank you for spending these few minutes with me. It really means a lot to me. If you found value in this video, make sure you subscribe to the channel for more videos like this, and I'll see you in the next one.